You're watching Masters in Trading Live with Jonathan Rose.
Hey there, everybody. It's Jonathan Rose, and welcome to another episode or edition of Masters in Trading Live. Every single day, guys, we get on here live, 11 o'clock Eastern Time, and I go over a few tidbits about the market, but every single day we share our number one trade of the day. What do we got going? Today is Wednesday. We have Fed coming out today. They're going to release that they're not going to change interest rates. Tomorrow we have Apple earnings, a big news event. And then on Friday, every single Friday in the beginning of the month, the first Friday is unemployment, non-farm payroll. That is a reason for the market to move. So we have three big events this week. We have Fed, we have Apple's earnings, and then we have unemployment. We also have anti-Semitism running rampant around college campuses, but yet the VIX is trading under 16. Last checked, 1550. So they're not pricing in a lot of risk in this market. That doesn't make a lot of sense to me. So let's go to the charts because the Fed announced something very interesting today that I want to go over. So here we go. Okay, so I have you at the charts, and before we get into the four topics, we're going to talk about some trade management. We have a limit order in Dash. Cancel that limit order. We didn't get filled. No harm, no foul. If you are working a limit order in Dash, cancel. No harm, no foul. ALAB. Yesterday I talked about ALAB. The day before I talked about ALAB. ALAB is a lockup, an IPO lockup. Trade behavior, it's going down, okay? 10 people take the exact same trade, you're going to get 10 different results. ALAB, I need you to stick with this trade. Some in the Discord community are already reporting locking in profits. Stick with ALAB. We are going to hold this until it's lockup. Okay, so this was baffling to me. Announced, let's talk about the Treasury buyback operations that was announced. Treasury buybacks of this size haven't been instituted since 2002. Interesting. So my question is, the Fed is raising interest rates, right? So when the Fed raises rates, bond prices go down. But this is confusing because now they're buying bonds and they're raising rates. How does that happen? So even though I've traded bonds professionally for 8 years, I was a sixth employee of a bond firm. We grew it to over 200 employees. I still wanted to ask ChatGPT, what the heck is going on? Why would they be buying back bonds while raising interest rates? And there were three answers. And for one, managing specific market conditions, fine. The Fed might be targeting different specific issues, specific maturities, balancing monetary policy. But what they're really doing is they are controlling the god-awful shape of that yield curve. Buyback programs can be used to influence the shape of the yield curve, potentially flattening it to avoid an inverted yield curve. Ooh, why would they want to avoid an inverted yield curve? Well, there have been 9 inverted yield curves in the history of the stock market. 8 have led to a recession. Right now, we have an inverted yield curve. Pardon me. What does that mean? That means short-term interest rates are higher than long-term interest rates. To show you the importance of the yield curve, I'm going to take you on a little history lesson. But before I do that, this takes you all the way back to 2006. These are all the different instruments, okay? This is 2-year, 3-year. We have 5-year bonds, 7-year notes, 10-year, okay? This is 5%, this is 0%. All the bonds, all these different maturities, right? In 2011. In 2019, all the same maturity. In 2024, all the same maturity. Really flat yield curve. Now I'm going to take you through a history lesson, okay? Because if I take you back to 2000, the yield curve, 3 months all the way up to 30-year, was 5% and it was flat, okay? Right here. Now we're going to go in '02. Market sold off, okay? I started trading bonds right in '02, by the way. Market sold off. Fed lowered interest rates. This is a normal shape for the yield curve. The Fed wants the market to go higher. '04, the Fed accomplishes, it gets the market moving. So what does it do? It moves those front rates. It's starting to get flat though. You see how it's losing its shape. It's not nice and healthy like this. We get to '07, '08 again. We are pancake flat. Doesn't it remind you of this? Right? Boom. And now here, right? We are flat, flat, flat. What happens next? Market gets annihilated. Here we go. Market starts moving. Fed lowers interest rates, right? Fed's trying to help out, making money cheaper. Market gets killed. We pin to 0. Hey, anybody could borrow money now. Interest rates are 0%. Please take our money, make it grow. As we move, the Fed still holding interest rates at 0 right before this gargantuan move. A little bit of a kink out here in the curve. Same thing, keeping rates nice and low. They've taken the 30-year down to under 2% now, okay? All in support of the market. Let's keep going on, because now we're going to get to 2019, going into COVID. COVID, free money again, right? Even if you want long-term money, guys, 1.5%, we want you to get dollars. Flat again. Now the market gets heavy. Market starts dropping. Fed starts moving. But look at this back end. It's doing absolutely nothing. 2% for 30 years or 2% for 3 months. Now, you can see what's going on. This is the yield curve right now. Okay? This is the yield curve right now. I'm going to go back 2 slides. 1 slide. 2 slides. Remember here. This will be 2. Remember here and remember here. Same exact behavior, right? So what are we going to do? Well, we're right here, right now. Okay? Now the soft landing is going to happen. The Fed lowers rates and we get that shape back in the yield curve. The problem and the issue is the long-term stuff is too cheap. The only way the long-term stuff stays here is if the Fed reduces rates to bring that shape back. But I don't see that happening anytime soon. The TLT is a great way to express 20 years of duration. The TLT can definitely trade lower, so we have more shape in this yield curve. Why do I show you all this? It's to follow the yield curve. The yield curve's in charge. That's what we need to follow. Let's move on. I want to move on because I got a great question from Robert. Robert, thanks for throwing the question in about the CBOE vertical spread. Now, the CBOE vertical spread was a trade that was shared last week. I think last week. Here's how it works. Let's say we do 10 and 10. So we do 10 and we do 10. When you buy 10 185 calls, you are long 1,000 shares. You're synthetically long 1,000 shares. Your 195s, if you sell 10, you're short 1,000 shares. Now it becomes really easy because at expiration, if the price of the stock is 182, the value is 0. Right? Because these are 0. You don't want to be long here, and you collect whatever it is you paid. So if you spent $1.50 on this vertical spread between the two of them, if it's at 182, you lose $1.50. Right? It's at 190, you also lose your $1.50. Robert's question was, actually, I'm sorry, 185. Now, Robert's question was, if it's at 190, what happens there? So at 190, these 185s are worth $5 less whatever you paid. So at 190, it's going to be $3.50. Right? Because $5 over that 185 minus that $1.50 that you paid to be in the spread. Hey, Robert, I hope that makes sense. How you could always think of these vertical spreads, if you just do one by one, long 100 shares, short 100 shares. Okay? If it gets here, this is the max that we can make. The max that we can make is the difference between the spreads or $8.50 because we had to do less, $1.50. Cool? Robert, let me know that makes sense for you. I got a cool divergence trade for you. This is a cool divergence trade because I've said this many times. 10 people take the exact same trade, you're going to have 10 different results. That's why I keep showing that ALAB trade. It's a lockup trade. It's a trade that every time it rallies, we want to buy trade. For those who have been watching the program, you're going to notice a familiar name. And that familiar name is slowly becoming a name that I don't like. Just for any reason, because it's being a brat. And that name is going to be BHP. BHP we've shared twice. But BHP is wrong. So I'm going to stick with it. Because the market is not always right. Jonathan's not always right as well. But the market's not always right. So all we can do is continue to make good trades, and over time, hopefully, those good trades pay off. Rio against BHP. These are two highly correlated trades, right? They are moving together. So we have Rio and BHP. Rio is going to be green, and BHP is going to be the purple. Look at them. They move together all the time. They don't break apart. Once in a while, they break apart, and whenever they break apart, they come together 100% of the time looking on this chart, right? So why the heck right now is BHP falling while Rio rallies? Now, FCX, another name that's correlated, is trading way up here, okay? It's done the same thing and then just broke out. FCX is way expensive, but the trade that I like, if you have BHP, I would buy more BHP. I love getting long BHP. This is the absolute correct trade. How you can protect yourself is we could sell upside calls in Rio. So buy BHP, and let's buy it, say, 100 times. The last trade in BHP is 55.15. Okay? How I like to do this trade is I like to sell one Rio call, $1.75 on the 70 strike. Okay? Now you may be thinking, all right, Jonathan, I see that they're really correlated. We're buying the purple. We're selling a call on the upside. But what happens if this relationship breaks down? Because you're right. We do have a naked call because we're selling one Rio against a BHP. If we sold one BHP, we would be in a covered call spread. But that's not what we're in. If you're not comfortable with this trade, something that you can do is you could buy one Rio, buy one Rio call for 50 cents. This way, it's a credit of $1.75, but this protects you in case Rio decides to trade 1,000. Not that it can actually trade 1,000, but if it trades 1,000, you don't want unlimited risk with that short call. So the trade, buy BHP, but to take advantage of the crazy divergence that will eventually come back together, I like selling one Rio call. To protect that one Rio call, we could also buy one of the 75 calls. It's a very cool trade, a little slightly sophisticated, but nothing that you guys can handle. If you have any questions or if this trade doesn't make sense at all, the first thing you need to do is paper trade, okay? As you watch these programs, you'll start to see it's really rinse and repeat. Something that I say often is, guys, we want to be on here to build that memory bank, to see experiences over and over and over. So if you're not too familiar with this trade, paper trade. Write out the trade on paper, follow it on paper, get comfortable with the risk on paper. Once you've done that, and then you're comfortable, then get in the market with real money. I'm going to get on here tomorrow, live, 11 o'clock Eastern, with our very best trade of the day. Until then, trade smart, guys. I'll see you tomorrow.
Join us every weekday at live.mastersintrading.com.